Assalamualaikum and a very good day, rise and shine, and welcome to my channel. Today what we're going to do is we're going to learn how to prepare a consolidated statement of financial position, which covers this. Our purpose is to actually learn how to compute goodwill when only ordinary shares in subsidiary were acquired. However, apart from covering that, the video will also cover whatever you see here, which is the first one. We're going to cover the preparation of consolidated statement of financial position on subsequent dates. On subsequent dates mean on the date, not on the date the shares were acquired, but after the date the shares were acquired. Maybe that takes after 1 year, after 2 years, or maybe after 4 years. So that depends, right? So that was on subsequent date, not on the date of acquisition, after the date of acquisition. Second one is to look at the concept or the principle of pre and post acquisition reserve. Pre and post acquisition reserve here is pre and post acquisition reserve in the subsidiary. Third one is we're going to look at our focus, which is how to calculate goodwill. And here our goodwill calculation is based on partial goodwill method, where the non-controlling interest is measured at its proportionate share of the fair value of net asset in subsidiary on the date of acquisition. And then I'm going to show you how to prepare or how to compute the group reserve and the non-controlling interest share of post-acquisition reserve using a schedule approach. You can also do this using a worksheet where the adjusting or the so-called consolidation entries are done to compute the group reserve and NCI share of post-acquisition reserve. But this is done for the examination purpose. So I'm going to show you the schedule approach. So let's look at the question. Before we look at the question, I want to actually go through with you a little bit on the concept of pre-acquisition and post-acquisition reserve, because this question covers the concept of that. So if you can recall, this is from the text that is in your reference list. The pre and post acquisition reserve in subsidiary can be divided into two. So I put this separately: pre-acquisition reserve and post-acquisition reserve. Okay, pre-acquisition reserve, it refers to all form of reserve, either capital or revenue reserve, that are made by the subsidiary company before the date the shares were acquired. I will show you a diagram in a short while. And then meaning to say that whatever before the date the shares were acquired. The second one is regarding post-acquisition reserve. This is where it refers to the reserve in the subsidiary company that were made after the date the shares are acquired by the parent. So to illustrate that, we will do that in a short while. But this pre-acquisition reserve, which is the reserve that were in the subsidiary company even before parent acquired it, that is a non-distributable reserve. What does that mean? It means that the acquirer, the parent, or the non-controlling interest themselves has no share of this subsidiary's pre-acquisition reserve. So it will be eliminated on the date of acquisition, because that belongs to the subsidiary themselves. So parent has no share. And then the second one is the post-acquisition reserve. I have mentioned that was due to the reserve made by the subsidiary after the date the shares were acquired by the parent. So this is a distributable reserve. So we need to look later how much is the share of this reserve, either general reserve or maybe a retained profit or maybe a revaluation reserve. How much is the share of the acquirer or the parent out of this post-acquisition reserve that will form part of the consolidated reserve, and how much also is the share of the non-controlling interest on this post-acquisition reserve, because that will be added to the carrying amount of the non-controlling interest that will later be disclosed in the statement of financial position, meaning consolidated statement of financial position, that is the group result. So let us look at what you have here, and I will go into this concept by applying the situation in this question. Right. We're going to look at the question, but before that I want to do a little amendment here to the cost of investment, just to make it higher. Okay, 450,000. You have the statement of financial position of Hood and Chill as at 30th of June 2000x2. So this is the reporting date, 30th of June 2000x2. That is the reporting date. And I'm going to put it red. Yeah. Okay. Then you have the two companies here. One is Hood, another is Chill. To know who is the parent, you need to read the additional information. Hood acquired ordinary shares of Chill. So the parties that acquire the shares are likely to be the parent. So Hood is the parent. On 1st of July 2000x1. So the date of acquisition is much earlier than the date or the reporting date. So 1st of July. So this is actually the date of acquisition. I put that as DOA. And you have, on that date, you have the retained profit and the general reserve of Shield, which is the pre-acquisition reserve balance, were 20,000 and 10,000 respectively. To illustrate this, I've drawn a diagram for you here. So on the date of acquisition, which is 1st of July 2000x1 here, the reserve of the subsidiary company has 20,000 and 10,000 respectively, which is from the information here, where the information is available here, when the retained profits and general reserve of Shield was having 20,000 and 10,000 respectively. So I put it here to show you better. So I'm drawing a timeline to illustrate that. And because I want to show the concept of pre-acquisition reserve. So meaning to say that this figure here, the one that you have here, 20,000 and 10,000 is the pre-acquisition reserve balance. Pre-acquisition reserve balance that stood in the subsidiary on the date the shares were acquired. And then you have another information, if you can see, in the statement of financial position, this one here, which is under the subsidiary column. I put it, I will take another color. Okay, this is the one that you have there. Okay, the 80,000 and 40,000 is the reserve that you have after a year. Why after a year? You acquired on 1st of July 2000x1. So after a year, 30th of June 2000x2, the reserve now has grown up from 20,000 for the retained profit, and it has grown up to 80,000. And for the general reserve, it has grown up from 10,000 to 40,000. So now we are interested in the changes of the reserve. So the changes of the reserve, which is the post-acquisition reserve. So you go and I'm going to put this where I have done that here. And I have drawn the diagram for you. So that figure 80,000 is here. So if you compare now 20,000 with 80,000, you can see that there is an increase of 60,000. An increase of 60,000. And that 60,000 increase, that 60,000 increase that you can see there, that is actually post-acquisition reserve. And then if you go to the general reserve here, 10,000 versus 40,000. And you can see that it has grown up by how much? Here, it has increased, right? Increased by 20,000. Sorry, by 30,000. Here, it also has increased by 60,000. Any changes to the reserve balances between the pre-acquisition balance and the balance at the end of the year, either a decrease or an increase, that is post-acquisition reserve. Here we have a post-acquisition reserve, which for a retained profit 60,000, and general reserve is 30,000. Why? Because holding company will have the right to the share of this post-acquisition reserve. Post-acquisition reserve, which is the orange color there, right? And here I put orange, and also this, the same, orange. Okay, so this is the post-acquisition reserve. So after you have considered all the intercompany transaction, all the adjustment, this part of it will be shared by parent, part of it will be shared by the non-controlling interest. That is the concept of pre-acquisition reserve and post-acquisition reserve. For this question, there are no such thing as intra-company or intra-group transaction yet. Now you're asked to calculate goodwill. So this is quite easy. You're going to do the relevant journal entries and to calculate the group reserve using a schedule and to prepare the consolidated statement of financial position. Not the full version, but just the extract version, because this is not a complete CSOFP that I'm sharing with you. I didn't give you the complete one. It was just an extract. Okay, so now what you need to do is number one, you need to do this to determine what is the controlling interest by the parent, hood, and what is the controlling interest by the subsidiary, shield. So by the parent, the controlling interest is, how do you determine that? You're not given the percentage directly, so you will take the investment that you made, 400,000, and you will divide with this is number of shares. So here it is 600,000, the number of shares in subsidiary, assuming that the value of the shares on that date is 1 ringgit, since there is no information telling you what is the units of the share available in the subsidiary on that date. So this one is also going to be the amount as well as the units. So we can assume this is at 1 ringgit, the fair value on the 30th of June, right? So 400,000 divided by 600,000. This is what you have here, 2/3, which is 2/3. Therefore, the remaining 1/3 will belong to the non-controlling interest. So I'm giving you some tips that I put here. You may want to draw a timeline diagram to differentiate between pre and post. Here I'm explaining the concept, and that was the reason I was drawing the timeline diagram. Right. Now we go to the second one, which is to calculate goodwill. Remember, to calculate goodwill on consolidation, you have 4 steps. The first one, you need to go and compute consideration transferred. So consideration transferred has been computed for you. I put here CT. CT stands for consideration transferred. I'm taking the one that were given in the question. So which is this one, 450,000. 450,000. Okay, 450,000. And that 450,000 is the one that will be shown here, meaning that in the working section. 450,000. The next one, step 2, you can see here, step 2, step 1, step 2, you have the step here that I put here for you. You can see that you need to go and calculate the fair value of net asset on the date of acquisition. In our focus, our calculation of goodwill is using partial goodwill method. So we are calculating the fair value of net asset. What is fair value of net asset? It is the equity balances available on the date of acquisition. Equity means it is actually the share capital and reserve. It can also be asset minus liabilities. But however, asset minus liability, they are equity. So you will calculate this fair value of net asset on the date of acquisition. And date of acquisition here is 1st of July. 1st of July 20x1. So 1st of July 20x1, that is the information. So what you need to do is you need to first take the share capital. Okay, for the share capital, we assume there are no changes in the share capital. So we'll just take what is in the information as per the CSOFP. For the retained profit and general reserve, which is your part of equity, you are going to take the balance that were pre-acquisition balance. Pre-acquisition balance, if we are doing our analysis, this is the balance, 20 and 10. Or if you look in the question, this is the amount given here, 20. And another one is 10. So you're going to take that and you're going to put here in the in the fair value of net asset. So you will put it here, right? And you get the total now. Which is 630. The total is 630. Right? So next step, step number 3 is to measure the non-controlling interest. So how do you measure? You're going to take the percentage held by the non-controlling interest, which is 1/3. Where do we get 1/3 from our workings here? Here. So that 1/3 or 1/3 will be multiplied with 630,000. This is 630,000, which is the fair value of net asset. Fair value of net asset, 630 times 1/3, that will give you 210. 210. So if you total up this, you will get what I call A, which is the total consideration transfer plus the non-controlling interest. So it is A. So now A exceed B. So if A exceed B by how much? By 30,000. So that 30,000 is your goodwill. If let's say A is less than B, that will give rise to bargain purchase. That will be covered later in the next example. Right. Now I'm just showing you the breakdown of the goodwill here. So to show you that goodwill is just related to the parent. That's why it's called partial goodwill, right? And now we are going to do the next one, which is to do the consolidation journal. So I'm always trying to advise you here that if you want to understand better, it's good that you can present the relevant consolidation journal. Here is a requirement for this question. So the consolidation journal will be one for the calculation of goodwill. I've already done that. Let me just reveal it for you, where what you will do is you are going to eliminate that. So how do you eliminate? You are going to eliminate the fair value of the net asset, which is the share capital, and then the retained profit and your general reserve. So I'm just taking from the cell there. And the goodwill we have already calculated. The goodwill is 30,000. So that will be the investment in subsidiary investment in subsidiary will have to be cancelled off because they are now going to be part of the group. So it will be cancelled off against the net asset acquired, right? Net asset acquired. So when you acquire the share capital, you also have acquired the net asset. So this is 30, right? And then you have investment in the subsidiary or in shares. This is directly from the question, which is 450,000. So I'm just showing you this one, 450. So you just include that. And the non-controlling interest you just calculated just now, 210. So done with the first journal entry. Next one is to learn how to prepare the schedule. The schedule, which is to go and compute the group reserve. We are going to learn how to calculate the group reserve and also the NCI share of the post-acquisition reserve as at the end of the reporting date. So this will be done via the schedule. So I'm using the schedule. So let's do that. So what do you need to put in the schedule? You need to put first the group reserve. If you have two group reserve, this one stands for group retained profit and group general reserve. And you will have, group is actually retained profit of the parent holding plus the share of the retained profit of the subsidiary, that is group retained profit. Same goes for the group general reserve. Where group general reserve here is the general reserve of the parenthood, and it will be added with the share of general reserve of the subsidiary that belongs to the parent. So how much is the share? For the parent, the share is 2/3, and for the NCI, there is also a share, which is 1/3. Before that, on the date of acquisition, you have some non-controlling interest amount already. So go and pick that amount that was here, 210. So just put it there. And that should be the first item that you show. Now we're going to look at the analysis of the reserve. So I'm starting off with what belongs to the parent first. I'm going to take what are the balance available in the parent as per the CSOFP. So this is the parent's information relating to retained profit and general reserve, this figure. So I will take this figure, yeah, which is this blue one, and I will put that in the correct column. For the retained profit, I will put in the retained profit column of the parent, and for the general reserve, I'll include that in the general reserve column of the group or the parent, because parent is the one that will prepare the result of the group. So you can see here, this is the amount. You can see another one, 50. Right. So that was the balance before any adjustment took place. There is no intercompany or intra-group transaction yet. Next, we are moving on to the subsidiary, who is the parent, in case you have forgotten. And Shield, that is going to be the subsidiary. Okay. So for Shield first, what you need to do is the same thing as what you do for your group. Put the balance as per the statement of financial position, as per inside the statement of financial position, which is the one that we have already decided much earlier, the one at the reporting date. This one. Okay. 80 and 40, put to the correct column. The correct column means you must make sure that it is under retained profit column of subsidiary. RPS means subsidiary, so put it there. Is 80. Another one is 40, right? So put it there. It is 40. So are we done yet? Not yet. So we need to now go and check the pre-acquisition balance. Remember, I told you earlier, our balance at the end of the year is 80. But our balance at the date we acquired the subsidiary was 20,000 and 10,000 for retained profit and general reserve respectively. So that is a pre-acquisition reserve, pre-acquisition balance for retained profit and general reserve. So that one shouldn't be shared by the parent. So therefore we need to remove that. To remove means this one will be the amount is, if you look, we need to check. Okay, 20 and 10. So here is 20. We need to remove, so I put negative 20 here because to remove 20,000. And that one would be 20. And for this one is 10. That also will be removed because those are the one that shouldn't be shared by the parent. So this will be removed. And the result of that is what you call post-acquisition balance. So the post-acquisition balance for general reserve is 60,000. The post-acquisition balance, I repeat again, for the retained profit is 60. And the post-acquisition balance for the general reserve is 30. Now, we need to go and distribute the reserve to the parent and to the non-controlling interest. To the parent, this one would be taking 60,000, if you can look at the formula there, multiply by 2/3. 2/3 is the percentage acquired by the parent. So if you take the post-acquisition balance, because there are no adjustment for intra-group transaction, if you have, you need to consider that first. So you are going to go and multiply with the percentage acquired by the parent. So you will get that 2/3 of 60, that will be 40,000. And that one will be shown in journal entry A because I want to show you the journal entry for post-acquisition balance. So I put A there, which is to show the distribution of that. So 40,000. And then you have one column here for NCI. NCI will get the remaining. Remaining means 60 minus 40. So NCI will get 20. 60 minus 40. 60,000 minus 40,000. Alternatively, you can take 60 times 1/3. That will still give you 20,000. So that will be shared by NCI as well as be shared by parent. So this is the parent column that will now form part of the group retained profit, the share of the subsidiaries post-acquisition profit. The second one is that the post-acquisition balance for the general reserve. So 2/3 of it, of course, it's 20,000. 2/3, 20,000. 20,000. I'm using purple, yeah. And another 1/3 will be shared by the parent, by the non-controlling interest. So 10,000. So the next stage is if you are to do the journal entry, so that will be to go and share the post-acquisition profits of S. S means subsidiary. So the retained profit, the total is 60,000, the one of the subsidiary. The group general reserve, the total is, the retained profit was 80. Oh, sorry, it is already correct. So I'm looking at the bottom here. So the figure here is 30. Post-acquisition, it is post-acquisition profit. So be careful with that. Don't take the wrong figure. You should take the post-acquisition profits and post-acquisition general reserve. And the amount that you will share here is, of course, this one is going to be 40. This is for general reserve, so it's going to be 20. And 20 is 30,000 times 2/3. I put here the workings. Another one is 10. 10 is 30,000 times 1/3. And for the group retained profit, it would be 40, 60,000 times 2/3, and 20. This is just to let you know the journal entry so that you won't simply just memorize what to add, what to minus. So what the next stage to do is to total up the column, each of the column, because these are the things that will be later transferred to the consolidated statement of financial position. So you are going to transfer it, total up. I have already sum up that. Okay, so you have three totals there, where this one represent group retained profit, the 220,000. This 70,000 represent the group general reserve, and 240,000 represent the non-controlling interest, the share of non-controlling interest on the date of acquisition, as well as the share in the post-acquisition reserve. So now you can prepare the statement. So the only share capital that you will show here, if you start with the equity, will just be those of parent. So if you look at the share capital of parent, you need to go and check. The information is given in the question. So it is 1.5 million. 1.5 million. So we're going to include there 1.5 million. Sorry about the... Okay, so it's going to be 1.5 million. So I just simply write that. And that was under parent column only. Why we do not include the subsidiaries share capital? Because it has been cancelled off. Check the journal entry here where I have already cancelled off the share capital with or against the investment. This is the reason that we do not include, in case you are asking. Next is to include what we have calculated earlier. Okay, for the group retained profit, you will take the column here, 220,000. For the group general reserve, you will take the column from the group general reserve, which is that column you can see there, the orange column. And for the non-controlling interest, it will be the light blue column, or the baby blue. Okay. Next one is the goodwill. Goodwill is a non-current asset. Earlier, we have debited the goodwill. So when we debit the goodwill, we have capitalized the goodwill as a non-current asset that arise during business combination. And this is actually the thing that you need to go and include in the statement of financial position. And the goodwill has been calculated earlier, and that was 30,000. Now what you should show here is the goodwill that are the remaining goodwill. Remaining goodwill means the goodwill after the impairment has been done. In this question, we have not discussed impairment. That will be done in our next question. So that's it for today. You have already prepared the consolidated statement of financial position where it has goodwill. And this is the preparation that you are doing after a year of acquisition. Remember, that is done on subsequent date, which is on 30th of June 2000X2. 30th of June. So you acquire, again, I remind you, you acquire on the date of acquisition 1st of July 2000X1. And in this example that I'm explaining is also talking about pre and post acquisition reserve. And pre and post acquisition reserve, as I mentioned in my slide here, not a slide, it's a diagram that I have made for you. These are not supposed to be shared for the pre-acquisition reserve, but for the post-acquisition reserve, it will be shared accordingly. With that, I thank you for watching. You catch me later for my next video on how to calculate bargain purchase using the same question. Stay tuned. I'll see you when I will see you. Assalamualaikum and have a nice day ahead.